Hey, junior high ag business, let's learn some basic business terms that you need to know to understand how business works in any business, but especially on a farm. So let's get going here by taking a look at one of these quizzes, and then I'll set it up so that you can take this test on your own. But let's go through this and learn some vocabulary first. Okay, anything that a farm owns that is worth money. Okay, so that's known as an asset. And these are examples of farm assets. You got combines, looks like a planter, something here about corn, fertilizer type of piece of equipment. Any of this stuff, this is all known as assets. Anything that is used in a business to help the business make money. So that's an asset. Anything the farm owes. So when you owe money to somebody, that's known as a liability. Let's say you borrow money to buy a car, or you borrow money to buy one of these tractors. If you have a loan and you have to pay that loan back, that is a liability. If you borrow money from a friend of yours to buy a bag of hot Cheetos and you got to pay them back, that's a loan. That's a liability until such time that you actually pay that back. The amount of the farm that the farmer owns, assets minus liabilities. So assets are the things that you own that are worth money. Liabilities, money that you owe to somebody, and the difference between those two is something called equity. So let's say the farmer buys one of these pieces of equipment here, like this tractor, and let's say it's a $100,000 tractor, and they borrow $50,000 to pay for the tractor from the bank. They borrow $50,000 from the bank, and the rest of the money they have in their savings account. They use their own money to pay for the rest of it. Then their equity would be $50,000 and the liability would be $50,000. Any asset that will last over a year is known as a long-term asset. Any asset that will be used within a year, short-term asset. So you might have a bunch of animal feed, hay. You might have seed that's in inventory, it's on your farm, but you're going to use it up fairly quickly, within a year. That would be a short-term asset. You might have a tank of fuel sitting on your property. It's going to be used up within a year. Any liability that you owe for longer than 1 year. So if you have some type of a loan, let's say for a house, a barn, some kind of a big building, it's going to be a long-term liability. It's going to take you quite a bit more than a year to pay that off. What is a short-term liability? Any liability, which is an amount you owe, that you will completely pay off within 1 year. So short-term in the world of business is a year or less. Long-term is over a year. The total amount of money the farmer makes. So the farmer grows all this stuff and then they sell it. And the total amount of money they make for selling all of it is something called gross revenue. They haven't subtracted out any expenses yet. It's just if they harvest this field of whatever this field is, I don't know what that is. Maybe it's wheat. Whatever this happens to be, when they sell that, the money they get for selling it is gross revenue. They will still have to pay expenses out of that money, but the initial money you get for selling something is called gross revenue. Now, net profit occurs after you take out the expenses. So you have gross revenue minus your expenses, and of course you have to pay taxes to the government on that income. So you subtract that all out and you have something called net profit. You're going to find this out when you go and start working somewhere. You'll be making money, you'll get a paycheck, but then you'll find that there are deductions. Things are subtracted from your paycheck, such as Social Security tax, Medicare tax. Might be some type of an insurance that comes out, unemployment tax, disability. I think they call that SDI, state disability insurance. You might find yourself earning $1,000 and then your check is for $750 because you had to pay all kinds of expenses and taxes. The expected value of an asset after the farmer is done with it. Okay, so when they buy these things like this big tractor, eventually it's not going to be new anymore. Just like if you have a car at home, some of your parents or people you live with might have an old car, and eventually you're going to have to get rid of it because it just becomes useless. You just wear it out, and whatever it's worth when you're done with it is something called salvage value. What amount can you get for just getting rid of it? Salvage value. Number 11. How many more we have? Oh, just a couple more. Good. Number 11. What is a financial statement that includes assets, liabilities, and equity? That is known as a balance sheet. Balance sheet, and that's enough to know that at this point. When you have a statement that talks about your assets, what you own, what you owe, and then what you have a claim to, or how much of these assets you've actually paid for, is known as a balance sheet. What is depreciation? Okay, so these things are assets. They lose value every year because they get older, just like if you have a car or boat or something like that, or motorcycle, or one of those, what are those Forerunner things that you have that, like a Polaris, one of those deals. Each year they lose value. They're worth less because they are wearing out. What we call in business depreciating. They depreciate. And so depreciation is the money value that assets lose each year. All right, let's go play this game, see how we do. And so I'll give you a lot of opportunities to take it several times. So do your best, try to get 100%.